Welcome to the deep dive. Today, we're going to be exploring Tivic Health Systems,
Okay.
a company that's making some very interesting moves in the healthcare space.
Yeah.
We've got articles, financial reports, and even a value investing analysis,
Nice.
all queued up. Tivic is listed under the ticker symbol TIVC,
Okay.
in case you want to follow along.
What's really interesting about Tivic is that they're not your typical pharmaceutical company.
Okay.
They're really rooted in bioelectronic medicine, which uses electrical stimulation to treat medical conditions.
Hmm.
Their initial product, ClearUP, targeted sinus pain, and they sold it directly to consumers.
So far, so good. But here's where things get interesting. They're now making a big push to become a diversified therapeutics company.
Yeah.
We're talking about a move into the potentially lucrative vagus nerve stimulation market, or VNS for short.
And to add another layer of intrigue, they just recently acquired a late-stage drug candidate for treating acute radiation syndrome.
Hold on, a drug. I thought they were all about bioelectronic devices.
That's what makes this so fascinating. They're branching out, trying to expand their reach and impact.
Right.
It's a bold strategy, especially considering they're a nanocap company with a market cap of just $6.63 million.
And let's not forget that wild stock price jumped almost 200% in a single day.
Right.
It's enough to make your head spin. Are they on the verge of a breakout, or is this just a temporary blip?
Well, that's what we're here to uncover.
Okay.
We need to understand their business, their management team, their financial health, and all the risks involved.
Right. So let's start with the basics.
Mm-hmm.
What exactly does Tivic Health Systems do, and what's their story?
Well, Tivic was founded in 2016, and they're headquartered in Hayward, California.
Okay.
Their initial focus was on developing and commercializing bioelectronic medicine,
Okay.
a field that uses electrical stimulation to treat various health conditions.
So instead of popping a pill, you're using a device to target specific nerves and modulate their activity.
Exactly. It's a non-invasive approach that could offer a potential alternative to pharmaceuticals for a range of conditions. Their first product, ClearUP, was a handheld device for relieving sinus pain.
Gotcha.
They went the direct-to-consumer route, selling it online and through their website.
But now they're setting their sights on bigger things.
They are indeed.
Okay.
They're transitioning into a diversified therapeutics company, aiming to go beyond their initial focus on sinus pain. This implies a higher risk, higher reward scenario, something to keep in mind as we move forward.
Definitely something to keep in mind. Okay, so we've got a company with a potentially disruptive technology making a big strategic shift. But what about the people leading the charge?
Well, let's take a look at the management team. At the helm is Jennifer Ernst, the CEO and co-founder.
Okay.
She brings over 20 years of experience from the tech industry.
That's interesting. A tech background leading a healthcare company. You don't see that every day.
It could be an advantage, actually.
Okay.
Her experience disrupting industries could translate well to the healthcare world, which is ripe for innovation.
I see your point. But their track record with ClearUP raises some concerns, doesn't it? How can we be confident they'll execute this new strategy any better?
That's a valid question, and we'll definitely delve deeper into their performance later on.
Okay.
But it is worth noting that the rest of the management team has solid experience in finance and neuromodulation device development.
Okay, so they have the expertise, at least on paper.
And they've got a strong board of directors as well, with backgrounds in digital health, medical devices, and entrepreneurship.
Okay.
There's definitely a breadth of experience there.
It sounds like a powerhouse team. But as you said, we need to see how that translates into real-world results.
For sure.
Speaking of results, let's dive into Tivic's financial health. And from what I've seen, this is where things get really interesting.
I agree.
Okay.
Their financials are a bit of a mixed bag. They're currently a nano-cap company, as we mentioned, and their stock price has been on a roller coaster ride lately. We'll get to that 200% jump in a bit.
Yes, let's unpack that. It definitely caught my attention.
First, let's look at their revenue. Unfortunately, it's been on the decline. In 2023, they brought in $1.18 million, which is a significant drop from the previous year.
Not exactly a sign of booming business. What's contributing to that decline?
Well, it's likely due to a combination of factors.
Okay.
Limited market awareness of their initial product competition in the sinus pain relief market, and perhaps their focus shifting towards these new ventures.
It makes you wonder if spreading themselves too thin could be a problem.
That's a valid concern. And to add to that, they've been operating at a loss. In 2023, their net loss was $8.24 million.
So declining revenue and significant losses, that doesn't sound too promising.
It does raise some red flags, but there are a couple of bright spots. After restructuring their supply chain, their gross margins have improved to around 70%.
Okay, so they're getting better at controlling costs.
Right.
That's a good sign, but is it enough to offset those losses?
That's the big question. And their cash position has also decreased, leaving them with $2.19 million in cash and cash equivalents. That's a limited runway. How long can they continue operating at a loss before needing more funding?
That's a key question for investors to consider.
So we've got a company with ambitious goals, a potentially game-changing technology, but also some serious financial hurdles to overcome.
It's definitely a complex picture.
Yeah.
We'll dive deeper into market sentiment, ownership structure, and their overall risk profile after a quick break.
Don't go anywhere. We'll be right back with more on Tivic Health Systems. And a reminder that you can find links to all the sources we're using for this deep dive in the episode description. All right, we're back and ready to continue our exploration of Tivic Health Systems. Before the break, we were digging into their financials, and it sounds like there are some challenges mixed in with the potential.
Precisely. Their financials definitely raise some questions, but let's not forget that incredible stock price jump we mentioned earlier, almost 200% in a single day. To understand that, we need to look beyond just the numbers and consider the broader market sentiment. How are investors feeling about Tivic right now? That's a great point. A sudden surge like that suggests something is generating excitement, even with those financial concerns we just discussed.
Exactly. It seems this surge might be linked to the news about their Intolimod acquisition. However, is that alone enough to justify such a massive spike?
Maybe. But let's not forget their share price is still down 43.55% over the past year. It's been a roller coaster ride, to say the least.
Yeah, that longer-term decline suggests a level of caution among investors. They're clearly intrigued by Tivic's potential, but also hesitant given their financial performance and the risks involved in such a dramatic strategic shift.
So, a healthy dose of skepticism is warranted. What about their beta? You mentioned that earlier. What does that tell us?
Their beta is 2.09, which indicates higher than average volatility, meaning the stock price is prone to big swings, reacting strongly to any news or developments.
That explains the wild ride we've seen. For some investors, that volatility might be appealing a chance for quick gains, but for others, it's a red flag.
Exactly. High volatility comes with high risk. It's crucial for investors to understand their own risk tolerance before jumping into a stock like this.
Speaking of risk, we should look at the short interest. What percentage of shares are being sold short?
Right now, it's sitting at 1.99% of outstanding shares. That's not incredibly high, but it shows that some investors are betting against Tivic, believing the stock price will go down.
Okay, so there are definitely some doubters out there. It seems the market sentiment is a bit of a mixed bag, excitement around the Intolimod acquisition and the potential of their technology, but also concerns about their financials and execution.
It's a classic case of weighing potential against risk. And to assess that risk further, let's delve into their ownership structure. Who are the key players holding the reins of this company?
That's a crucial piece of the puzzle. It can tell us a lot about who's driving the decision-making and what their motivations might be.
Absolutely. When we look at the breakdown, it's striking how little ownership insiders have a mere 0.14% of outstanding shares.
Wow, that's incredibly low. Why wouldn't the management team and board have more skin in the game?
It could signal a lack of confidence in the company's future, or perhaps they see their compensation packages as sufficient incentive. It's definitely something investors should consider.
What about institutional investors? Are they more involved?
They hold a slightly larger share, 4.70%, but it's still relatively small compared to other companies.
So the vast majority of shares are held by retail investors.
Exactly. The remaining 95.16% is considered the float shares available for public trading. This suggests that Tivic's stock price might be more susceptible to swings based on retail investor sentiment, which can be more volatile and driven by short-term trends.
That reinforces the need for caution and thorough due diligence before investing in a company like this.
Yeah.
We've got high volatility, low insider ownership, and a heavy reliance on retail investors.
It all adds up to a higher risk profile. But remember, risk and reward often go hand in hand. To truly assess Tivic's potential, we need to conduct a comprehensive risk assessment.
All right, let's do that. What's the best way to break down the risks and opportunities facing Tivic?
A classic SWOT analysis will help us get a clearer picture. We'll examine their strengths, weaknesses, opportunities, and threats.
Sounds like a plan. Let's start with their strengths. What advantages does Tivic have in this competitive healthcare landscape?
Well, their core technology is definitely a strength. Non-invasive neuromodulation offers a unique and potentially disruptive approach to treating a variety of conditions. It's a key differentiator in a crowded market.
And they've been building up their intellectual property portfolio as well. They have 16 issued patents and 10 pending, which suggests a commitment to innovation.
That's a significant advantage in a field like bioelectronic medicine, where research and development are crucial.
And we can't forget their management team. While their track record with ClearP might be debatable, they do have a wealth of experience in the tech industry, finance, and neuromodulation device development.
Their board of directors also brings diverse expertise to the table, so they have a solid foundation of experience and knowledge to draw upon.
Okay, so they have some definite strengths. But let's be realistic. No company is without its weaknesses. What are some of the challenges Tivic needs to overcome?
Well, their financial performance is the most glaring weakness. Declining revenue net losses and a dwindling cash position are serious concerns.
Yes, those are major hurdles. They need to demonstrate a path to profitability, and sooner investors might start losing patience.
Absolutely. Another weakness is their limited market awareness and adoption. Bioelectronic medicine is still a relatively new field, so they face an uphill battle in educating consumers and healthcare providers about its benefits.
It's a classic chicken and egg problem.
Yeah.
They need more awareness to drive adoption, but they need adoption to generate revenue and build awareness.
Exactly. And right now, they're heavily reliant on ClearUP. If that product falters, the whole company could be in trouble.
So diversifying their offerings is crucial. And it seems like they're trying to do that with their move into the VNS market and the acquisition of Intellimod. Those could be major opportunities, right?
They could be. The VNS market is projected to be worth billions in the coming years, and Tivic is developing its own non-invasive VNS device.
That sounds promising.
Yeah.
But is Tivic really positioned to compete with established players in such a crowded market?
That's a valid question. They're definitely entering a space with some big names and fierce competition. It'll be crucial for them to differentiate themselves, demonstrate the efficacy of their device, and secure regulatory approvals.
And what about Intellimod? What are the opportunities and risks associated with that acquisition?
Well, Intellimod has the potential to be a game changer. It's a late-stage drug candidate for treating acute radiation syndrome, a life-threatening condition with limited treatment options.
So they're going after a niche market with a potentially high-impact drug.
Exactly. And the market for ARS treatment is estimated to be worth $5.2 billion. If Intellimod is approved and gains traction, it could be a significant revenue generator for Tivic.
It sounds like a high-risk, high-reward play.
Yeah.
But let's not get ahead of ourselves. They still need to navigate the regulatory hurdles and prove the drug's effectiveness in clinical trials.
You're absolutely right. And even if they're successful, they'll face competition from other pharmaceutical companies in the ARS treatment space.
So lots of potential, but also lots of obstacles to overcome.
That brings us to the T in our SWOT analysis threats. What external factors could hinder Tivic's success?
Well, we've already touched on competition. They're up against some formidable players in both the bioelectronic medicine and pharmaceutical markets.
Competition is definitely a major threat. They'll need to fight for market share, secure partnerships, and convince investors that they have a winning strategy.
And in the healthcare industry, reimbursement is always a challenge. They need to convince insurance companies to cover their treatments and devices, which can be a lengthy and unpredictable process.
That's a crucial point. Without adequate reimbursement, their products might not be accessible to a wide enough patient population, limiting their revenue potential.
And of course, regulatory hurdles are always a factor in healthcare. New products, especially those involving bioelectronic medicine, face a rigorous approval process, which can be time-consuming and costly.
Absolutely. They need to navigate the FDA approval process effectively, and any delays or setbacks could significantly impact their timeline and financial projections.
And looming over all of this is the risk of being delisted from the NASDAQ. Their stock price has been below $1 for a while now. If they don't regain compliance, it could damage investor confidence and limit their access to capital.
That's a real concern. Being delisted would make it more difficult for them to raise funds and execute their ambitious plans. It could create a downward spiral that's hard to reverse.
So it's a precarious situation. We've covered a lot of ground here, from their business model and financials to market sentiment and risk assessment. It's a lot to process.
It is a complex picture, and we've only scratched the surface. But this detailed analysis is essential for understanding the challenges and opportunities facing Tivic. They're a company at a crossroads, making bold moves to transform themselves, but facing significant risks along the way.
Will their strategic shifts be enough to turn the tide? We'll have to wait and see. But one thing that could be a real game changer is their acquisition of Intellimod.
Yeah. We'll dive into that more after a quick message. If you find these deep dives helpful and want to explore more fascinating companies and investment opportunities, be sure to subscribe to the Stock Analytics AI YouTube channel.
We're using cutting-edge research and artificial intelligence to uncover hidden gems and provide valuable insights for investors of all levels. And if you're looking for some potentially intriguing stock suggestions, check out the comments section below. We'll be back in a moment with more on Tivic Health Systems and their potentially revolutionary new drug. We're back with the final part of our deep dive into Tivic Health Systems. Before the break, we were discussing their strategic moves, including their acquisition of Entolimod, a potential game changer in their story.
Yeah, let's unpack this acquisition a bit further. Entolimod, as we mentioned, is a late-stage drug candidate that Tivic acquired from Statera Biopharma.
Right, and it's intended to treat acute radiation syndrome, or ARS.
Exactly. Now, you might be wondering what's so special about the ARS market. Well, think of it as a critical need with limited solutions. ARS is a life-threatening condition that can occur after exposure to high doses of radiation, such as in nuclear accidents or radiological attacks. Effective treatments are desperately needed, and that's where Entolimod comes in.
This is not just about market size, it's about addressing a real and urgent medical need.
Precisely. And the market itself is substantial, estimated to be worth around $5.2 billion. For a company like Tivic with a relatively small market cap, the potential impact of a successful ARS treatment could be enormous.
It could transform their entire trajectory. But we need to understand how Entolimod works and what makes it a promising candidate.
Entolimod is a toll-like receptor 5 agonist. In simpler terms, imagine a drug that kickstarts your immune system into overdrive. That's essentially what Entolimod does. It helps the body fight off the damaging effects of radiation exposure.
So it's not directly targeting the radiation itself, but rather boosting the body's natural defenses to cope with the damage.
Exactly. And the research behind Entolimod is encouraging. It's already undergone over 40 animal and human trials demonstrating its potential in treating ARS. What's more, it has received FDA Fast Track and Orphan Drug designations.
For those who aren't familiar with those designations, what do they mean in practical terms?
They're a big deal. It means the FDA recognizes Entolimod's potential to address an unmet medical need and is expediting the approval process. This can significantly shorten the time it takes for a drug to reach the market.
So there's a real sense of urgency and priority surrounding this drug. It's not just some experimental therapy languishing in a lab.
It's far from it. Entolimod is on a clear path towards potential approval, and that's what's generating so much excitement around Tivic.
It's a remarkable story, really. They started with a consumer device for sinus pain, and now they're on the cusp of potentially launching a life-saving drug.
It speaks to their ambition and their willingness to adapt. They're not just a bioelectronic medicine company anymore. They're evolving into a diversified therapeutics company with a portfolio that spans devices and pharmaceuticals.
It's a bold move, and there are definitely risks involved. Can they successfully manage this transition? Can they compete effectively in both the bioelectronic and pharmaceutical markets?
Those are the million-dollar questions. It all comes down to execution. They need to secure funding, navigate the regulatory landscape, build strong partnerships, and demonstrate the effectiveness of their products.
And they need to do all of this while managing their existing business and addressing their financial challenges.
It's a tall order, but not impossible. They have a unique combination of assets, a promising technology, a potentially groundbreaking drug, and a team with diverse experience.
A classic underdog story. Can they overcome the odds and achieve their ambitious goals? Only time will tell. But one thing is for sure, this is a company worth watching.
It certainly is. Tivic Health Systems is a prime example of the dynamic nature of the healthcare industry. New technologies, innovative treatments, and strategic acquisitions are constantly reshaping the landscape. And companies like Tivic, willing to take risks and adapt, have the potential to make a real impact.
Their story is a reminder that even small companies can play a big role in driving progress and addressing critical medical needs. But it's also a reminder that investing in such companies comes with inherent risks.
That's why it's crucial to conduct thorough research, consider your own risk tolerance, and consult with a financial advisor before making any investment decisions.
Absolutely. This deep dive has provided a comprehensive overview of Tivic Health Systems, but it's just a starting point. If you're interested in learning more, be sure to check out the sources we've listed in the episode description. And for those of you who want to stay ahead of the curve in the world of finance and technology, don't forget to subscribe to the Stock Analytics AI YouTube channel. We're using cutting-edge research and AI to uncover hidden gems and provide valuable insights for investors of all levels.
And remember, this deep dive is for informational purposes only and not investment advice. Do your own research, consider your risk tolerance, and consult with a financial advisor before making any investment decisions. We love hearing from our listeners. If you have any thoughts or questions about Tivic Health Systems or any other company you'd like us to cover, leave a comment below. Until next time, keep learning, keep exploring.